Market is pricing in what he would call a shallow recession. It is pricing in a downturn. You look at the financial services companies, you look at the activity that's going on in the banks. They're not really seeing a lot of capital markets activity. You get 7 IPOs. Last year you had 60. So, that sector has been facing that. You look at the cyclicals, you look at the industrials. They're all pricing in, quote, a slowdown. And then, to Bryn's point, and you look at consumer staples, they're all pricing in. Why would stocks trade at, Coke trade at 26 times earnings? So a lot of this has been priced in. Do we know the extent of how low earnings are going to go? No, we don't. We do know that the market looks forward 12, 18 months, and some of this could be, hey, we're getting to a base where earnings are bottoming. Could they go down another quarter? Absolutely. But when you get all these input prices coming down, you get copper, steel, lumber, more inventory in the targets of the world, I think you're seeing some deflationary effect there as well. So, yes, we're very dependent on the Fed. We're going to see what they do. My bet is that they're still going to raise. They've got to put marbles back in the jar. But as a long-term investor, look for some opportunities here. We've always said that. And I think, as earnings kind of come down, some of these stocks could re-rate. Some of them are re-rated already, so just be careful. But I think there's going to be opportunities abound.
What about that 4,200 call from Stifel today and the areas that they like? And by the way, Evercore also is out today suggesting that the rally off of the June 17 low has further to run, and they're positioning for upside with NASDAQ growth. They think that's where the outperformance is going to come. So everybody, not everybody, but at least these two groups are back on the tech train.
Yeah, and I think part of that is some of these tech stocks have really been beaten up, and there is high-quality tech out there. I mean, I think of NVIDIA in there, of Qualcomm, some of these higher-value companies that have true earnings, true cash flow. They're not growth at any price. They're growth at reasonable prices. And if we do think that we come out of this in the next 12 to 18 months, these companies have been so beaten up, trading at multiples we haven't seen in a long time. So, yeah, I do think you can get that, but I do think you can get it in other parts of the market, too. I don't think it's going to be just the tech trade that we saw for the last 10 years.
But is it dangerous, Joe, to jump on this train if we're going to use that thing ahead of earnings? The stocks have run a lot into earnings. That doesn't mean they're going to run out the other side of the tunnel after earnings as well. Is it too dangerous to get into these stocks today, given the moves that they've had? Apple, perfect example, up 15%. NVIDIA, as we said, back at the 50-day and up 7% today.
So I'll borrow our eternal optimist line, Stephen Weiss, where he said tradable bounce. I think this is a tradable bounce. Do I think you can buy select financials after earnings? Yes. Would I go out and buy a lot of the technology companies yet to report right here? No. I want to hear what earnings are going to look like. Then on the other side, I would step out.
Well, why have they run the way they have, these tech stocks? Because they were just beaten down a lot?
Because the economy is signaling that we are having a growth scare. When you have a growth scare, you're going to strategically turn to, as Surratt said and Bryn said, growth at a reasonable price. You're not going to look at profitable technology companies and buy those right here. The risk assumption is far too great there. But you are going to look at companies that have free cash flow generation in the present and are reasonably priced, understanding that growth is going to dominate in an environment where you have an economic contraction. It's making a return. Listen, if there was one position where it was clear the speculative community was overwhelmingly positioned towards, that was underweight growth in the month of June.
Bryn, you want to weigh in?
Yeah, I think where, I'm spot on with Joe on tech. I think you want to wait and listen to these companies, and here's why, is that if you look at the tech sector from the S&P, 45% of revenues for tech are overseas. And so you have the dollar, that's fine, and I don't think people are going to be punitive because the dollar's strength. But if you think about that consumer, that 45% of the revenues are from international, the U.S. is doing really well. But overseas, I think between, China, which is still a huge wild card, Europe probably goes into a hard recession, or at least it feels that way just because of their energy crisis. And so I think investors should take this quarter's earnings to listen to that, and then I think there's going to be some huge opportunities. But I would wait to add to those positions over the next few weeks until you do hear, because that heavy international revenue exposure could definitely be punitive to some of these companies that have less sales because of that.